Hey, hi there. Welcome to the video. Rate of saving versus rate of borrowing. So this is the part 4 of the interest rate concept series. Okay, so let's start with the video now. So if you have already watched my previous video, okay, that is the part 3 of the interest rates concept series, where we saw how compounding helps you, your saving grow faster. Okay, where we saw compounding helps your savings grow faster. Okay, so the idea is the more often interest is added to your principal, okay, frequency of interest being added to the principal, okay, the more powerful the effect you will see. So the more powerful the effect you see, that is, you earn more as you keep on earning interest on the interest. Okay, so this was the idea that we had seen in the previous video, compounding. Okay, so this is the case of saving. We saw all about case of saving. Okay, but there is a flip side, and the flip side is, what if you are what if you are borrowing instead of saving? Okay, so in this case, in case of borrowing, the compounding isn't your best friend. It can work. Okay, it can work. So compounding can work against you. So in case of saving, compounding is your best friend. Your money keeps on growing faster. But in the case of borrowing, compounding can work against you. Okay, so this is what we are going to discuss in this video. Okay, so let me add a new slide here. All right, so let's start with the basic. Okay, the very basic thing that you need to understand, okay, is, I will write it here. When you put your money in a bank, this means you are lending money to the bank. Okay, and this lets you earn some interest. That is, the bank gives you some interest on the money that you put with them. Okay, so let's break down this concept. Okay, so when you put your money into a savings account or a deposit account, saving or a deposit account at a bank, okay, you might think that your money is just sitting idle and getting you certain interest on earned on top of that. Okay, but what happens actually, but you are lending that money to bank. Okay, you lend money to bank. Now this money, the money you have lent to bank, this money is utilized by bank to give loans to other people. Okay, to businesses or persons. So for example, they give personal loans personal loans, they give business loans, they give car loans. Okay, they don't keep your money up in a locker. They use those money to give loans to others, and they charge extra, or you can say higher interest. They charge higher interest on these loans. Okay, and of this, some portion of this interest, some portion of this interest is paid to you. That is, they give to you as a saving interest. Okay, it's like kind of, you can say, thank you. The bank is telling you thank you, okay, for lending your money. I mean, for lending, letting them to use your money for giving loan to others. Okay, this is kind of a thank you. Okay, so even though you are called as a saver, so if you see from your perspective, you are a saver. You are saver here. Okay, but in technical terms, if you see, okay, you are actually a lender to the bank. You are actually a lender to the bank. If you see in technical terms, you are a lender to the bank. Okay, so in some time I will give you some examples. I will give you an example, and then the things will be much more clear. Okay, so there are two sides of interest rate. Okay, so whenever you put your money in a bank, you are lending money to the bank, and that money is being utilized by the bank to lend or to give loans to other people. Okay, and for that they pay you certain interest, that is your saving interest, right? Now when you as a borrower go to bank and take some loans from the bank, you are borrowing money from the bank. In that case, okay, in that case, you pay interest. Here you pay interest, and this is your borrowing interest rate. Okay, the rate that you earn earn in case of saving interest, that is the saving interest, is always lower. So saving interest rate is always lower than the rate that you pay, that is your borrowing interest rate. So let's take an example. For example, let's say you deposit rupees 10,000, let's assume. Okay, and the interest rate here is, for example, let's say 4% per annum, that is 4% annualized interest rate. After 1 year, so if the time period is 1 year, after 1 year you would earn here some interest, that is 10,000 into 4 by 100 into 1, that is 400 rupees. You will end up earning rupees 400 on 10,000. Okay, now imagine if you are borrowing the money. So let's say you borrow money. In case of borrowing, you are borrowing, that is the principal here would be 10,000 rupees. Okay, and the bank here charges you not 4% but 12% here. That is the higher interest rate than the saving interest that you are getting from the bank. Okay, so bank charges you 12% annualized interest rate, and after 1 year here, if you see, the total interest that you interest paid here will be 10,000 into 12 by 100 into 1, that is 1200 rupees. So you are paying interest of rupees 1200 as a borrower, but you are getting only 400 rupees as a saver. So there is a spread of, there is a difference of, that is rupees 800. This rupees 800 is the profit for the bank. Okay, so while borrowing, you end up giving total payment you made is 11,200. That is 10,000 is your principal, the amount that you borrowed, plus 1200 as interest. And in case of saving, that is the lender to the bank, you have got 10,400 rupees only. Okay, so on one hand the bank is giving you 4% to a depositor when you are a saver. Okay, on the other hand, the bank is charging 12% from the borrowers if you are borrowing the money. This 8% difference, right? This 8% difference is the bank's profit margin. This is what called profit margin of bank. Profit margin. So they are simply using your deposited money to lend it to someone and earn certain money on top of that. Okay, so from this example it is clear to you how you are lending money to the bank. But the next question that can come to your mind is, why is borrowing rate higher? This is the question that can come to your mind. So let's break it down now. Okay, so the very first point here is, whenever the bank is lending some loans to other people, or you are borrowing money from the bank, there are three things that is kept in mind. The first thing is risk for the bank. Okay, so let's discuss about this. So there is always a chance, okay, that a borrower may not repay the loan. So you as a borrower, it is possible that after taking loan you are not able to repay the loan amount or interest to the bank. So in this case the bank charges extra interest to cover that. Okay, this is one reason. The second is operational costs. Okay, so bank have many expenses like salaries. They pay salaries to their employees, people working for them. They pay rent where they have their branches. They pay money for some infrastructures using electricity and all, okay, etc. So these are the operational cost for a bank, and these operational cost they add it into the cost of borrowing. Okay, so this is the second, and the third reason is profit margin. So bank is also a kind of business, you can say. Bank is a kind of business, so they also want to earn some money. They want to earn money. And how they do? By lending money to others. And what are these money? Your savings. Okay, so these are the three reasons why borrowing rate is higher than the saving rates. Okay, and remember one thing, if you remember from compounding, from compounding, remember the concept of compounding applies even when you are borrowing money. Okay, not only while saving money. So whenever you are borrowing money, the concept of compounding applies here as well. So for example, let's say if you delay your payment or miss EMIs, you delay the payment. When you are a borrower, you delay the payment or miss some EMIs that you have to pay monthly. Okay, the interest gets added to your loan account. So if you have 10,000 as your principal and you are required to pay the EMI or some interest, let's say of rupees 1200 here, you are required to pay 1200 of interest. And if you miss the payment of this interest amount, or you don't pay, this 1200 interest gets added to your principal. So now your entire principal will be rupees 11,200. Okay, and here, okay, interest starts being charged on top of this. Now your principal changed to 11,200, and the next month the interest will be charged on this amount and not on only 10,000. There will be one more zero. Okay, so here, okay, you will be paying interest on interest. You are paying interest on interest. you end up paying interest on interest. This is how the small loans, when you take small loans, and it becomes bigger and bigger if you are not careful. Okay, so it is always said that be careful, okay, while borrowing money. Whenever you borrow money from any banks or any institution, you always be careful, otherwise you end up paying more and more. Okay, and hence the compounding is a double-edged sword. So we say compounding, you can note it down, compounding. So compounding is a double-edged sword. So it is amazing for savers but dangerous for careless borrowers. It is amazing for savers but very dangerous for careless borrowers. If you are a careless borrower, you will end up paying more and more. Okay, so this is the reason why borrowing is higher, and how compounding can act against you in case of borrowing if you are not careful. So let's say you have a future goal. Okay, you have a future goal, and what is that? Buying a bike. So this is your future goal, and the cost of this bike is rupees 1,20,000, let's say, for example. Okay, now you have two options. You have two options. Option number one, okay, you save rupees 10,000 per month. You save 10,000 every month and earn 4% interest on this, on top of this. And the option two is borrow rupees 1,20,000 today. You buy the bike now, and repay the loan over a year at 12% per annum, 12% interest rate. In option one, if you see, you will have to wait for 1 year. Every year you will deposit, you will save 10,000 rupees, and you will have to wait for 1 year. Okay, and then you will be able to finally buy the bike, plus you will also earn some interest on top of that. In option 2, if you see, you buy now, enjoy the bike, and repay the loan amount over a year at 12% interest rate. In option 2, you end up paying more, end up paying more. Why you are paying more? In order to enjoy the bike now. So you can enjoy the bike now only, but you end up paying 12% interest rate on top of that. So you can see here from this example, okay, it is a choice between time and cost. It is you who has to decide between time and cost. Okay, the choice is completely on time and cost. So either you save every month and get the bike, earn some interest on that, wait for 1 year, or you buy now, you will save time and pay additional 12% interest rate in order to enjoy the bike right now. So here one thing that we have to understand, okay, so always understand that you earn less when you save. You can see here, when you are saving, you are earning only 4%, but pay more, that is 12%, when you borrow. Okay, so that's the reason we say that it is important to understand how interest rates work before making any financial decision. Here you have to make a financial decision, and in order to make this decision, you need to understand how interest rates work, what is the amount of interest you are getting when you are saving the money for 1 year, and what is the interest rate you are paying when you are using you are borrowing the money from the bank at higher interest rate. So if you see here, saving is slow, but borrowing, but it has some steady growth. If you see, you are getting 4% interest rate, but borrowing gives you faster access to money. No doubt it is giving faster access to money, but it costs you more. So after 1 year, when you have paid 12 all 120 1,20,000 rupees for bike plus 12% interest rate, you will see that the cost of bike after 1 year is more than 120,000. That is 1,20,000. Okay, so you end up paying more when you borrow money in order to have access to money faster. So there is one more question that can come to your mind: when to borrow? Okay, this question can often come to mind: when shall you borrow money? And the answer here is very simple if you think it clearly. Okay, so if you expect to earn more money, so whatever money you are going to borrow, okay, if you think you can earn more using that borrowed money, okay, it can be like investing in business or education. Borrowing makes more sense here. So if it is for a purpose like investing in business or for education, in this case borrowing makes more sense. But if you are spending borrowed money on non-essential thing, spending money, that is the borrowed money, on non-essential things, then you might just end up paying more. You might end up paying more here, more, for no return. There won't be any return and you end up paying more. Okay, so this is where you have to think it carefully before borrowing money. All right, so I can take an example here. So let's say if you are going to buy a bike to travel to workplace, that can help you save some time, and that particular time can utilize, okay, can be utilized in some productive work, and in return that gives you some good financial benefit in the medium or to long term. Okay, then borrowing money is justified here. It makes more sense here. But if you just want to buy bike in order to enjoy the bike ride, then borrowing might just end up paying more for no return. Okay, so this is the concept when you should think to borrow. All right, so that's all for this video. I hope I was able to be very clear to explain how rates of saving and rates of borrowing works, and when you should borrow money. Okay, so that's it for this video. Thank you and happy learning.